Hi, my name is Jenny Thorvaldson. I'm the Chief Economist and Director of Data Development here at IMPLAN. And today I'm going to talk about output and GDP. These are some well-known concepts, but they have specific definitions that can be surprising to some folks. And they also have specific definitions within IMPLAN. So it's kind of important for us to talk about these a little bit. Let me go ahead and share my screen. And I will start my presentation. Great. All right, so we'll talk about the definitions and the difference between them, their main uses, and some very important features about them. Also talk about our data sources for them. So basically our agenda today will be similar for each of them. We'll start with output and its definition in IMPLAN, some important features about it, and the raw data sources. And then we'll do the same for GDP. So let's start with output. What does that mean? It can have a lot of, this word means a lot of things to various people and in various contexts. So in the context of IMPLAN, it is the total value of production. And this, I'll show you, we'll see this in a later slide, but just want to mention right now that this is very important to use this definition, these words, total value of production, because a lot of folks tend to equate output with sales or revenue, and they're not always the same. And we'll talk about why in a little bit. So that's just pointing out that that's a very specific and intentional use of words here, that a total value of production is the most accurate and the most precise definition, and applies no matter what industry we're talking about. So it's the safest one to use, and it includes the value of intermediate inputs and value added. And value added has 4 components here. So let me just talk about each of those. So intermediate inputs are the inputs from other industries or other businesses within the same industry that go into producing this particular industry's output. So these intermediate inputs could be physical things like ingredients or parts or things like that, but they could also be services, and very often are services. So they're purchases from other industries. And then value added is what this industry adds, to the value of those inputs. So it could be assembling those inputs, transforming them in some way, packaging them in some way, somehow adding labor and other things, and money, capital, whatever, to those inputs, and combining those things to make its output. And so it's intermediate inputs plus value added. Value added has these 4 components. We'll talk about them more later, but I'll define them for you here since I'm using acronyms. We have employee compensation, and that's basically wages and salaries earned by employees plus any benefits plus payroll taxes. So basically the total cost of the employees that are in that industry. And then proprietor income, and that's basically for folks who aren't employees but are proprietors, and what they make and then earn in that year in that industry. And then other property income, which is almost entirely corporate profits, is what that is largely made up of. And then taxes on production and imports, net of subsidies. And that is mathematically how we calculate output. Now, some important features. As I mentioned previously, output does not always equal sales. And this can be for a couple of reasons. One is inventory. There are a lot of industries which have inventory. And so an industry can sell things that it produced in a previous year. And so in that case, sales might be greater than the value of production in this year, because maybe we sold what we produced plus sold some of the stuff that we produced last year that's sitting in inventory. And it could go the opposite way as well. We could sell less than we produced in a year less than our value of production because we may have put some of this year's production into inventory. So they don't always equal one another. And what's important, the reason why we want value of production rather than sales is because that's what matters more for economic impact analysis, which is IMPLAN's main thing. And when we want to know that the impact that an industry has on other industries in the region or on other regions, we need to know how much they produced that year, because that's what influences how much they bought from other industries that year, or how much labor they hired and paid that year. So what was produced that year and the value of it is what matters. So that's why we do value of production, not sales or revenue. Okay, another important sector to pay attention to here with output is wholesale and retail sectors. So as we all know, wholesale and retail sectors do not manufacture or make the things that they sell on their shelves. And so we can't count the value of those things as being output of those sectors. The output, what those sectors do is they provide heat and light and the shelves, and they bring all together these items so that we can just go to one store and buy a variety of things. And they provide employees to help us check out. And they provide shopping carts for us to put our items in. Those are services. That's the retail service that they provide, these sectors. And so the value of that service is the output of those sectors. So the output of those sectors will definitely not equal sales, because sales includes the value of the thing that was on the shelf, right? And so basically the output of the wholesale and retail sectors in IMPLAN is not those sector sales, but just that value add, that kind of the retail markup on those items, and it's just the value of the service that they provide. Okay, another important feature is that changes in output do not always reflect a change in physical production. And an important reason for this is very topical today is inflation. So the price of something could go up. Let's suppose the price of something goes up and the industry producing that thing produces the exact same amount as last year. Well, output is going to go up because the price of each unit, even though there's the same number of units, the price per unit has increased. So increased price times the number of units, we're going to get greater output. So just to keep that in mind, that when an industry's output increases, it doesn't necessarily mean that they're pumping out more of that thing. This matters more in times of really high inflation, which we don't have that often. We just kind of happen to be in one right now. And also with commodities with volatile prices. So things like agricultural commodities, they tend to change in price a lot. Also things like oil and gas and refined petroleum, those things change in price a lot. So you want to pay attention to that if you're looking at those sectors in particular. Another important feature is that output double counts the value of production of an entire economy. So what do I mean by that? When I mentioned, if you recall the equation for output, it includes the value of inputs plus the value added that this industry has added to those inputs to make its output. So the value of those inputs is getting counted twice, because the sectors that produced them, the value of it gets counted there in their output. And then if it's used as an input in another sector, then that value of that input is included in this sector's output. So it's being counted twice. And so that's just something that surprises people sometimes. And that's why we at IMPLAN advise users when they're reporting their economic impact results to focus more on value added or GDP than on output for this reason. So an example of this would be, and we'll talk about it more later, but car manufacturing. So there's a car manufacturing industry in IMPLAN, and there's also various car parts manufacturing industries in IMPLAN. So when so the car manufacturing sector doesn't actually make the tires and the windshields and the upholstery. It puts those all together. It puts the windshield on the frame and it paints the vehicle, does whatever car manufacturing sector does, it does those things, but it doesn't make those various car parts. So if we look at the tire manufacturing industry, it's going to have the value of tires that it produced that year, and it's going to be counted as that industry's output. The car manufacturing industry's output, since it includes the value of inputs, it includes the value of those tires. So see how that's been counted twice. So that's why you just have to have a little caution when reporting output number. It's still a valid number to use for various reasons, but you just need to know that about it. And that's why we try to emphasize GDP or value added, which we use those terms interchangeably in input. And we'll talk about that more later. Okay, so just to give you an overview of our main data sources for output in IMPLAN, we only have one source of county level raw output data, and that's the Census of Agriculture. So we get county level output data for farm sectors. Now, of course, the Census of Agriculture only comes out every 5 years, so we use that as kind of our a base number, but then we have to project it to the current year of IMPLAN data. But it is really great that we have county level raw data for that. Now, sources of national level raw output data, we have various sources that we use for different types of industries, different industries. So we have the annual survey of manufacturers, which we use for most manufacturing sectors. Then the Bureau of Economic Analysis, the BEA, has a series of an output series. And we use that in IMPLAN for our construction sectors and most of our service sectors. The U.S. Census Bureau, from them we get two different tables of retail sector data, and we use that for our retail sectors, of course. And then NOAA, the National Oceanic and Atmospheric Administration, from them we actually get our data on commercial fishing output. And then we use the Energy Information Administration for oil and gas extraction industry, the petroleum refining industry, and our electricity industries. So we do try to use very specific data sources for output when we can, when we have those available. Now, since these are at the national level, we distribute these values to states and counties based on a variety of other data that we do have at those at those smaller geographic levels, like employment and labor income and things like that. All right, so now let's move on to GDP, gross domestic product. Now, most of you have heard about it, heard of that term, and are probably very familiar with it. So I'm just going to talk about the definition of it in IMPLAN and some features about it and our data sources for it. So I'm going to start with just putting up here again the definition of output. Output was intermediate, or the equation for output, intermediate inputs plus value added. And again, there are the four components of value added that we already talked about. So GDP is just that value added component. So in IMPLAN, we really use those terms interchangeably, GDP and value added. They're synonymous. But when you're talking about it in industry, we just more often use the term value added, whereas GDP, you kind of think of it more as on a regional level. So if you're looking at the region as a whole and not looking at a specific industry, you're probably more likely to refer to that as GDP. And if you're talking about an industry, you're going to talk about value added, but those are synonymous in IMPLAN. Okay, and we talked about the four components, and so we don't really need to talk about that anymore, just to sort of highlight that. And so an important feature of GDP is that it doesn't double count, because if you go back here, you'll see that it doesn't include the value of inputs. So it's only including the value that this industry adds to those inputs. And so the value that it adds to its final product. And how does it add value to that? By assembling various inputs, putting on finishing touches or packaging, bundling with other products, variety of ways, adding ingenuity and labor to do whatever sort of manipulation to those inputs and creating a new product out of it. So it's just only measures that additional value that this industry adds. So that's why we really like to emphasize this one. We already talked about the example with auto manufacturing. Here's another example would be food manufacturing. That industry adds value to the various ingredients, which are grown by the farm industries, by putting them together according to recipes, cooking them, freezing them, drying them, packaging them, whatever they do to take raw ingredients and turn them into something else. Just a couple things I want to mention about GDP. We've all heard of it. It's very, most countries report GDP, which is very useful because it makes it very handy to compare GDP across countries and across time. So it's an apples to apples, which is really nice. Of course, different countries are probably have more accurate measures of GDP than others, but it is very useful in that. And it's nice that most folks are trying to measure the same thing. But it is a flawed measure of a region's wealth, and I just wanted to point out some of the reasons for that. It does exclude the value of economic activities that aren't officially monitored by the government. So maybe think of some things like babysitting or lawn mowing where the person is paid in cash and may not report it, may not pay taxes on it, and illegal drug sales. And these are things that are part of the economy. They're moving money around, but they're not measured in GDP. It also excludes the value of public stocks of goods such as open space, clean water, clean air, healthy forests, things that are important to the folks in a region, but their value, they're not traded in the open market typically, and so their value doesn't get counted anywhere in GDP anyway. And then it doesn't say anything about the distribution of the wealth. So it is helpful if someone at least compares to the GDP of a country to its population, so we get a GDP per capita. That's helpful, but it doesn't. But of course, GDP isn't spread evenly among every person in a country, so it doesn't really get at anything about an unequal distribution of GDP or wealth among the people in that place. And then, of course, it does kind of assume that wealth equals happiness. And we all know that there's other things that are important to well-being, such as human rights, healthcare, clean environment, things like that. So just wanted to point that out. While GDP is super important and useful, it's not a complete measure of well-being, I guess you could say, of a country. Now let's turn to our data sources. If you recall, GDP or value added has 4 main components. So we do have different data sources for the different components. We turn to the Bureau of Labor Statistics Census of Employment and Wages data to get wage and salary income. And we use this data source because it has the most industry detail of any data source. It has data at the 6-digit NAICS level. If that doesn't mean anything to you, that's okay. Just know that it's very detailed. It has more sectors than IMPLAN has. So it's sufficiently detailed for us, which is great. I also haven't defined for you wage and salary income, but just know that it's a component of employee compensation. If you remember, employee compensation was wage and salary income plus benefits and payroll taxes, things like that. So this gives us that component. And then we turn to the Bureau of Economic Analysis, the BEA, and 3 of their data sets, regional economic accounts, other value added, and state GDP data to get us employee compensation. So that gives us the information on benefits and payroll taxes, to get us proprietor income, to give us they give us gross operating surplus and TOPI. Now, gross operating surplus, I haven't defined for you yet, but basically it is proprietor income plus other property income. So those two components of value added together. So the BEA's other value added and state GDP data only give us GOS, which is those two components combined. But it's okay because we have other data on proprietor income. So all we have to do to get other property income, OPI, is just to take the estimate of gross operating surplus, GOS, and subtract off our estimates of proprietor income, and we are left with an estimate of OPI. So that's how we do that. And then the BEA also has something called the NEPA tables, which is the National Income and Product Account tables, and they provide national control totals for all of these things. And the IMPLAN data all sum up to our NEPA table control totals, and I'll prove that to you in my last slide. But just want to mention that in addition to providing control totals for these items here, value added, I also wanted to mention that the BEA NEPA tables, not only do they provide annual GDP data, which we use for our annual IMPLAN data sets, they also provide quarterly GDP data, and IMPLAN does use those for quarterly data that we put out. Just want to mention that those quarterly data in IMPLAN are only available in what we are calling the data library portion of IMPLAN, and that's that part of IMPLAN is more for researching trends over time, trends across geographies, looking at location quotients, things really focusing on the data more so than on economic impacts. That's separate. Data library is separate from the economic impact tool. So the quarterly data are only available in the data library kind of research part of IMPLAN, whereas the annual data that we put out for GDP is also available in the economic impact tool part of that. The BEA does go back and revise its initial estimates of GDP, both quarterly and annual. They typically produce 3 vintages of their GDP estimates. It's great to know that their revisions, so they go back and they have kind of advanced estimates, and then they go back and revise them when they get more data and go make their number a little bit more precise. And it's great to know that those revisions average less than a 1% change. So they're not really that consequential, but it is nice that they do go up and update those when they get new data. And just wanted you all to know that IMPLAN uses the second release of the quarterly data and the third release of the annual data. The reason we use the second release instead of waiting for the third release of the quarterly data is that part of the reason for us producing quarterly IMPLAN data is for its timeliness. We really want to get data out a little bit faster for folks who are really monitoring changes in the economy and want our kind of advanced estimates. And also want to mention that in data library, it's not just GDP that we have quarterly data for. It's basically almost all the things that we produce on an annual basis, we produce on a quarterly basis. So output by industry, value added by industry, employment, labor income, all of those things. The main components of our annual data are also in our quarterly data, but they are advanced estimates. And so they're a little less fully curated than our annual data. And finally, as promised, just want to show you that IMPLAN data do really match what's in the BEA's NEPA data. So this first screenshot on the top of the slide, you'll see here that after the 2020 data year, you look over, you have gross domestic product, and there you'll see $20.894 trillion was the GDP of the US in 2020. And if you look in this, compare that to the second screenshot of the NEPA table here, gross domestic product, there you will see that the BEA reported that exact same number. So we are matching the BEA perfectly. We just have some more zeros in ours because we're in different units. In IMPLAN there in dollars, and here you can see that the BEA table was in millions. So we just have a few extra zeros, but we do actually match. And just wanted to point out that anything that the BEA NEPA tables have a US control for, the IMPLAN data will match that. And that was all I have today. Thank you so much. We'll see you next time.